studying your last two. I swim with tea when they turned in. The staring out to mute and can lend a pole that some kid died.
This slide introduces an important planning concept that many owner-managers overlook. When discussing salary versus dividends, many people focus only on the corporation. They look at corporate taxes, payroll costs, dividend taxation, and personal tax rates. But great tax planning goes much further than that. Great tax planning looks at the entire family. At the center of the slide, we see an owner-manager family standing in front of a daycare facility. This image represents the real-world situation faced by many business owners. They are not making tax decisions in isolation. They are making decisions while managing a household, raising children, paying bills, and planning for their family's future. On the left side of the slide, we see the business planning side of the equation. This includes decisions about corporate income, salary payments, dividends, payroll, and overall tax planning. These are the traditional areas that advisors often focus on when working with owner-managers, and they are certainly important. However, they are only part of the story. On the right side of the slide, we see the family planning side. This includes daycare costs, babysitters, after-school care, summer camps, and other child care expenses. For many families, these costs represent a significant annual expense. And unlike some other household expenses, child care costs can have important tax implications. This is where the puzzle pieces in the center become so important. One piece represents business planning. The other represents family planning. When these two pieces come together, we create a more complete planning process. The best tax outcomes often occur when business decisions and family circumstances are considered together rather than separately. Notice the advisor's message at the top of the slide. Don't forget the child care deduction. That simple reminder captures the essence of this entire scenario. When compensation planning is being discussed, child care expenses should also be part of the conversation. If they are ignored, important planning opportunities may be missed. Many owner-managers are surprised to discover that family expenses can influence what appears to be a purely business decision. The choice between salary and dividends may affect access to certain deductions, credits, and planning opportunities available at the personal level. That is why professional advisors look beyond the corporation itself. At the bottom of the slide, we see 4 areas that may be affected by child care expenses. First, tax savings. Child care expenses may help reduce taxable income and improve overall tax efficiency. Second, compensation decisions. The existence of child care deductions may influence whether salary, dividends, or a combination of both creates the best overall outcome. Third, family cash flow. Reducing taxes can leave more money available for household needs and long-term goals. And fourth, overall planning results. When family circumstances are incorporated into the planning process, recommendations become more accurate and more valuable. The most important lesson from this slide is that tax planning should never happen in a vacuum. The corporation matters. The tax return matters. But the family matters too. Professional advisors understand that the best recommendations are usually those that consider all parts of the client's financial life. And that leads directly to the key message at the bottom of the slide. The best tax plan looks at the whole family picture. When business planning and family planning work together, the result is often better tax efficiency, stronger cash flow, and better outcomes for everyone involved. This slide explores one of the most important planning insights in the entire child care discussion. Sometimes the option that appears best when looking only at salary and dividends is not actually the best outcome for the family. To understand why, we need to look at the connection between earned income and child care deductions. Let's start on the left side of the slide. Here we see the salary strategy. The owner-manager receives salary from the corporation. That salary is reported as employment income and creates earned income for tax purposes. This earned income is important because many personal tax planning opportunities are connected to earned income. In this example, we are focusing on child care expenses. The flow shown on the slide is straightforward. Salary creates earned income. Earned income supports access to child care deduction planning. The child care deduction can then reduce taxable income, and lower taxable income can result in lower taxes. The key point is that salary may provide more than just cash. It may also create additional planning opportunities that improve the overall family tax result. That is why the green side of the slide highlights a deduction opportunity. The value of paying salary is not always limited to the salary itself. Now let's move to the right side of the slide and examine the dividend strategy. In this scenario, the owner-manager receives dividends from the corporation. Dividends can be an excellent planning tool in many situations and often play an important role in owner-manager compensation strategies. However, dividends are different from salary. They do not create earned income. Because earned income is not created, certain planning opportunities may be affected. The slide highlights this as a planning consideration rather than a problem. This distinction is important. The objective is not to suggest that dividends are bad. The objective is to recognize that different compensation methods can create different planning outcomes. That is why professional advisors look beyond simple tax calculations. At the center of the slide, we see the daycare and family illustration. This visual reminds us who the planning is actually for. Not the corporation, not the tax return, the family. The goal is to improve the family's overall financial outcome. Notice the advisor's message at the top. Always check how child care expenses affect compensation planning. This is exactly how experienced advisors think. Before recommending salary, dividends, or a combination of both, they evaluate how family deductions and family circumstances may influence the final result. A strategy that appears slightly less attractive on paper could potentially produce a better overall family outcome when child care deductions are considered. That is why the family benefits box is positioned in the center of the slide. The ultimate objective is not simply minimizing one specific tax calculation. The objective is maximizing the family's overall financial position. At the bottom of the slide, we see the most important lesson. The lowest tax option on paper may not be the best family outcome. This statement captures the essence of integrated tax planning. Professional advisors do not optimize one number. They optimize the complete picture. They consider compensation decisions, family deductions, cash flow, personal taxes, corporate taxes, and long-term goals. When all of those factors are considered together, better decisions become possible. And that is the real lesson of this slide. Child care expenses are not separate from compensation planning. They are part of compensation planning. The best strategy is often the one that creates the strongest overall result for the entire family, not simply the one that produces the lowest tax number in isolation. This slide brings together the most important lesson from the entire child care planning scenario. The difference between basic tax preparation and professional tax planning is not the ability to calculate taxes. The difference is the ability to see the bigger picture. At the center of the slide, we see an advisor meeting with an owner-manager family. This image represents the reality of effective tax planning. The advisor is not looking at a single tax return. The advisor is looking at an entire family's financial situation. Notice the speech bubble above the meeting table. The best tax plan is rarely about one number. That statement captures the entire philosophy behind this slide. Many people approach tax planning by focusing on one question. Should I take salary or dividends? While that is certainly an important question, it is only one piece of a much larger puzzle. On the left side of the slide, we see the mindset of a basic planner. The basic planner focuses almost entirely on salary versus dividends. They compare the numbers, calculate the taxes, and choose the option that appears best based on that single comparison. But professional advisors think differently. They understand that compensation decisions affect many other areas of a client's life. That is why the family sits at the center of this planning framework. Surrounding the family are 6 key factors that professional advisors evaluate. The first is salary strategy. How much salary should be paid? How does that salary affect deductions, credits, retirement planning, and overall tax outcomes? The second is dividend strategy. How do dividends fit into the broader compensation plan? How do they affect personal taxes and family cash flow? The third factor is child care expenses. This is the focus of our current scenario. Professional advisors understand that child care expenses can influence compensation planning decisions and overall tax efficiency. The fourth factor is tax savings. Not just corporate tax savings, not just personal tax savings, total family tax savings. The fifth factor is family cash flow. A technically perfect tax strategy may not be the best strategy if it creates cash flow challenges for the family. Professional advisors evaluate both taxes and practical financial realities. And finally, the sixth factor is long-term family goals. This includes education funding, retirement planning, family security, and future financial objectives. The advisor's job is to make sure today's tax decisions support tomorrow's goals. Now look at the comparison between the basic planner and the professional advisor. The professional advisor considers salary, dividends, child care expenses, the family's overall situation, and long-term objectives. This broader perspective produces stronger recommendations because it reflects how families actually live and make financial decisions. At the bottom of the slide, we see the results of integrated family tax planning: better family outcomes, more accurate planning, improved tax efficiency, stronger cash flow management, and better client advice. These are the benefits that come from looking beyond a single tax calculation. This is why professional tax planning is so valuable. It recognizes that financial decisions are interconnected. A change in one area often affects multiple other areas. And the best recommendations are usually those that balance all of those factors together. That brings us to the final message at the bottom of the slide. Great tax planning integrates business decisions with family realities. When advisors combine compensation planning, family expenses, tax efficiency, cash flow considerations, and long-term goals into a single strategy, they create recommendations that are not only technically correct, but genuinely beneficial for the family. And that is what professional tax planning is all about.